Welcome back to Boring Currency, where we track physical metals, paper market stress, and the forces reshaping the global financial system. Right now, the screens are glowing green. The fear appears to have faded. If you glance at the charts, you could easily believe the danger has passed. You might assume the market has found its footing again. But I need you to rewind the tape in your mind. Go back to last Friday afternoon, 3:09 p.m. Eastern Time. Do you remember that moment? Within just 48 hours, gold collapsed nearly 20%. Silver had months of upside erased in one brutal vertical red candle. The financial media labeled it a correction. They called it profit-taking. They are misleading you. What you witnessed last Friday was not a healthy pullback. It was a liquidity purge. A deliberate mechanical operation engineered to rip assets out of weak hands ahead of a major policy move. I need you to stop celebrating the rebound for a second. Set the coffee down and study the volume bars, not the price candles. Because while you were watching the collapse in shock, a $10 billion signature was being placed on a document in Washington. Before we open the file on the actual Exim Bank press release, which is sitting right here on my desk, I want to ask the serious observers something. When the algorithms triggered that sell-off last Friday, did you stay in your position or did the volatility shake you out? Now let's surgically remove the noise and examine the anatomy of this event. To understand why silver is green today, you first need to understand exactly how it was executed last Friday. Most retail traders see a red candle on a chart. An institutional analyst looks at the same chart and sees a crime scene. The crash that unfolded Friday afternoon was not driven by real-world fundamentals. No mines shut down. No factories stopped buying chips or solar panels. Physical demand never disappeared. What happened was a leverage purge carried out with precision. Here's how the operation works. The Chicago Mercantile Exchange, which controls the paper derivatives market for precious metals, uses a tool called the initial margin requirement. This is the cash you must post to hold a contract. When silver began climbing too aggressively earlier in the week, threatening to break above the $50 level, the exchange raised those margin requirements. This is standard procedure, but the timing was flawless. It happened late Friday. Asian markets were closed. The London fix was finished. Liquidity, meaning the market's ability to absorb selling without collapsing, was at its weakest point of the week. When margin requirements rise, leveraged speculators receive margin calls. They have two options: add cash immediately or sell their position at market prices to cover the obligation. On a Friday afternoon, hedge funds and algorithms don't wire cash. They sell. That triggers a feedback loop. The initial selling pushes prices lower. That drop activates stop-loss orders from the next tier of traders. Their forced selling drives prices down again, triggering additional margin calls. It becomes a cascade, a domino chain designed to erase leverage. Frank Giustra, who has spent 4 decades in this industry, confirmed this was a technical takedown, not a shift in fundamentals. But this is where the story pivots from market mechanics to geopolitical strategy. While paper traders were panic-selling Friday, the U.S. government was preparing to step in. On Monday, headlines screamed about a $12 billion stimulus, but I pulled the actual Export-Import Bank Board press release dated February 2nd. Read the fine print. It is not a $12 billion giveaway. It is a direct loan of up to $10 billion. That distinction matters. The remaining $2 billion doesn't come from taxpayers or printing presses. It comes from private sector partners named explicitly in paragraph 3. Hartree Partners, Mercuria Americas, and Trafigura. If you don't recognize those names, you shouldn't be trading commodities. These aren't banks or tech firms. These are the shadow giants of physical trade. They move real molecules across the globe: oil, copper, cobalt, and silver. By handing them $10 billion in cheap government financing, the U.S. didn't just enter the market. It armed the most aggressive traders on Earth and told them to clear inventory. If Washington tried to buy silver directly, the market would laugh. Bureaucrats are slow and price-insensitive, but Mercuria and Trafigura are predators. They know refinery schedules, shipping routes, and exactly where weak hands are holding physical inventory. This deal is a public-private partnership. In plain terms, the government absorbs the risk, and private traders execute the strategy. The state provides the balance sheet. The traders provide the muscle. These firms put up $2 billion of their own capital to unlock $10 billion in government leverage, a 5.1 ratio backed by the state. They need lower prices to enter. That explains the Friday crash. The COMEX leverage flush depressed paper prices, creating a gap from physical reality. That allowed Project Vault partners to lock in long-term physical supply at discounts. While you were dumping silver ETFs because the chart looked ugly, government-backed entities were securing the supply chain for the next decade. Look at who they're buying for. The document names Boeing, Western Digital, and GE Vernova. That tells you exactly where the metal is headed, not jewelry, aerospace, data infrastructure, and the power grid. Boeing can't build guidance systems without silver. Western Digital can't power the AI revolution without silver. GE Vernova can't rebuild the grid without silver. These companies are now state-supported hoarders. The just-in-time model is dead. It's been replaced by just-in-case stockpiling funded by Exim. This is the rise of Western state capitalism. Private competition is being replaced by national security allocation. When the government becomes the whale, price sensitivity disappears. Corporations have budgets. Governments print currency. The next time you see a Friday flash crash, ask yourself who benefits. The answer is in the document. The answer is Project Vault. To grasp the weight of this document, we need to step out of the present and into history. Why is the US suddenly partnering with commodity traders to stockpile metal? The answer lies in a vault sealed for over 70 years. Frank Giustra raised a chilling fact. The last full audit of U.S. gold reserves at Fort Knox occurred in 1953. Eisenhower was president. Television was new. The internet didn't exist. The entire global financial system rests on metal that hasn't been properly verified in 3/4 of a century. But while gold is mysterious, silver is catastrophic. We don't need guesses. The U.S. strategic silver stockpile is zero. In the mid-20th century, America held the largest silver reserve ever. Then Washington sold it. Billions of ounces dumped to suppress prices and paper over deficits. Now they're trying to buy it back, after it's gone. China didn't make that mistake. While the West financialized, the East industrialized. China stockpiled. Official Chinese gold numbers are fiction. Track refinery flows and Shanghai deliveries, and the truth is obvious. And now China is tightening export licenses on silver. This isn't a tariff. It's supply denial. They control refining. They control flow. On one side, the U.S. deploys $10 billion to secure inventory. On the other, China controls the warehouse keys. This is a silent war fought through supply chains. Paper markets are colliding with physical hoarding. The leasing era is ending. You can't build jets with Bitcoin or missiles with bonds. You need metal. Project Vault isn't stimulus, it's panic. When a superpower panics, silver doesn't just rise, it detaches from reality. We're moving from speculative pricing to desperation pricing. The vaults are empty. The bridge is a dying dollar. Strip away politics and look at physics. Silver is indispensable. It's the most conductive, reflective, and thermally efficient metal known. That's why Boeing, Western Digital, and GE Vernova are named. Weapons systems, AI data centers, and energy grids all depend on silver. Now look at supply. 5 consecutive years of deficit. Hundreds of millions of ounces gone. Stockpiles drained. COMEX registered inventories down nearly 70%. We're scraping the bottom. Friday's crash scared paper traders. Industrial buyers saw a gift. Industrial demand is inelastic. When volatility hits, they hoard. That explains today's rebound. The vacuum absorbed every ounce. That $10 billion loan exists to secure supply before it vanishes. We are nearing the point where screen prices don't matter, because metal isn't available. This is unobtainium. If you have it, you set the price. If you don't, production stops. The bounce you see today is the market realizing Friday created zero new silver. It only fed whales. The deficit remains, demand accelerates, vaults empty. So where does that leave us? The data is clear. Don't fight this capital stack. Shorting this market is standing in front of a freight train. But leverage is deadly too. The rational path is physical alignment. De-risk. Reduce counterparties. Own what exists. Project Vault is proof the buying has only begun. Trust documents, not headlines. And if you want more sharp updates like this on boring currency, subscribe and comment boring currency so I know you're part of the community. This video is for education and discussion only. I'm not your financial advisor. I don't know your personal situation, and nothing here is a buy or sell recommendation. Do your own research and think for yourself. Stay safe.